Well, for more on our top line story and his take on where markets are going, we're joined now by a friend of the program, Ryan Lewenza, joins us in studio for the first time in a while. Thanks for joining us, Ryan.
Great to be back.
Ryan is Senior VP and Portfolio Manager at Turner Investments at Raymond James. Your quick take on this Rogers Shaw thing. The lawyers representing the transaction, lawyers for Rogers and Shaw, are arguing this is a pro-competitive deal. They say TELUS needs more competition in the West.
Well, of course, that's going to be their spin. They want to do this, complete this deal. It's been going on for over a year. I can't even imagine how much money has been invested in this. So they want to do anything to get this deal done. From the moment this deal was announced, I thought that this was, you're removing a major player. You're going to go down from, what, 5 kind of somewhat national carriers down to 4. You're removing a major player. So I don't really know how that happens, how that helps competition. Canada already pays some of the highest wireless fees of developed countries. I kind of liken it back to the banks. Remember many years ago when we had the potential for, I think it was CIBC and another bank in the federal regulators stopped that. I think it's very similar to that. So I think it's a pretty hard case to make that this is going to lower these wireless fees that Canadians pay, which are through the roof.
Okay, let's go to some thoughts you've got on the market. Investors this year have been waiting for any sign that inflation, particularly in the U.S., the most influential economy of the world, has peaked and is tracking down, and because they are eagerly awaiting a pause from the Fed on these rate hikes and eventually a move down perhaps on rate hikes by the Fed. You think we're not far away?
Yeah, I mean, this is the story. This is the most important thing that's happening in the markets is this high inflation. I think we have peaked. So you've got 2 types of inflation. You have the headline inflation, which includes food and energy. That peaked at 9.1% about 4 or 5 months ago. It's been trending lower. Why? Because commodities are coming off. Now we got core inflation. That remains hot. That's at about 6.6%. But when I look at a lot of the components that go into it, wages peaked earlier this year. Those are coming down. When I look at dwelling costs, so that's home prices, rents, home prices are starting to come down. Rents typically lag. So I'm starting to see all these measures that are rolling over. And so when you kind of connect the dots, I think we're going to see smaller or actually deflationary prints on a monthly basis. This will be the proof or evidence that the Fed needs. Okay, they're working. The economy's slowing. The inflation's coming off. Now we can start to take the foot off the pedal. And look, last week in the communication, they had some changed language. They kind of referenced that we could start to alter it. This is how the Fed does it. They start to do it. They start telegraphing these changes. And so I think we're going to start to see basically them peaking. First quarter of next year, that's when I think they take the foot off the pedal and stop hiking rates. Okay,
now let's bring back that graph that we had on, because I think the discussion now flows into how the market reacts. And you've given us an interesting graph here. It does require a bit of explanation. On the left-hand side, we see the S&P 500 forward price earnings multiple. That is the blue line on this graph. The right-hand axis is what's important to explain here. That measures the yield on the U.S. 10-year bond. That's the white line, but you have inverted the right-hand scale here. So viewers will notice that as that right-hand scale moves down, the yield on the 10-year gets higher. So you've done this to align those 2 lines. You take it from there. What's this relationship showing us?
Well, that's a great summary, great explanation. So the key here is real simple, the connection between interest rates and the stock market. So as the Fed is hiking rates, this is causing concern amongst investors, slowing down the economy. Rates are going up, stock market's rolling over, and the PE is compressing. So if you look at the right side of the chart, the white line is U.S. interest rates. It's going down on the chart, which means rates are going up. It is weighing on the stock market. Play that chart forward. If I think inflation has peaked, the Federal Reserve will stop hiking rates in the first quarter. Interest rates should peak early next year. That white line will start to go up on the chart, meaning interest rates will go down. That will lead to a recovery of the stock market and an expanding PE. This is the most important chart for the stock market. In a year from now, you have me back on. We look where the U.S. interest rates are, and if I'm right about connecting these dots, I think the stock market will be higher.
Okay, that's